Hi, welcome to my channel Too Irrational. I'm Pranay Sharma, and in this video we are going to discuss the solutions of CM1 paper A conducted by IFoA in 2022. We'll go through the detailed explanation of each of these questions, but if you want the answer sheet, you should WhatsApp or Telegram your email ID and your phone number to the number that I'm giving you below and ask for the CM1 solutions. Let's get started. Question number 1. Calculate showing all workings 3.5Q 56.25 assuming a constant force of mortality between integer ages. Now here the number of integer ages that we are crossing is definitely more than 1. So we'll have to split them. We can split only using P. So the first thing is 3.5 P 56.25. I'll split them into 0.75 P 56.25. completing to 57, then P57, P58, and from 59 we'll go for another 0.75 years. In using constant force of mortality, we can calculate these two and these two directly from the table book. So the 3.5 Q 56.25 would be 1 minus of 3.5 P 56.25, and that turns out to be 0.0218728. Let's go to question number 2. Let's read question number 2. A non-tax-paying investor wishes to invest a lump sum for a period of 5 years. The investor is considering depositing a lump sum with a bank. Interest will be credited to the initial lump sum at a variable market rate. Interest will only be added when the cash is withdrawn. The investor has set up a generalized cash flow model for this investment. Describe the cash flow with reference to the certain and uncertainty of the size and the timing of the payment from the investor's point of view. So we'll say from the investor's point of view, a negative certain cash flow at time 0 equal to the amount of the lump sum to be invested. As the interest rate is uncertain, the positive cash flow at the certain time 5 will be of uncertain amount but higher than the lump sum invested. Let's see question number 3. Question number 3. An individual aged 20 exact wishes to purchase a commercial property at age 45 which is currently priced at 1 million. They plan to save a fixed amount X monthly in advance for the first 10 years, then 2X monthly in advance for the remainder of the term. The investment return is expected to be 2.5% per annum effective, and property price inflation is expected to be 0.5% effective per half year. Calculate X using annuity function. You must show all working. So in question number 3, the first thing is we'll find the inflated price. So because they had 0.5% per half year, so that is why we have 50 half years in those 25 years. So the first thing we'll find the inflated price as we had 0.5% per half year, so therefore raised to 50. Then we'll make the annuity equation 12x because the payment is monthly. For 10 years payable 12 times, payable in advance. Then you will accumulate it for another 15 years. And then 2x, so therefore we have 24x for the next 15 years. You can also make the equation as 12x going for the complete 25 years, payable 12 times. And for the last 15 years, we have another 12x. This will also give you the same answer. Let's see the next question. Question number 4. Describe in words the meaning of the following. So that is expected present value of a lump sum payment of 1 given on death of life age 45, or you can write immediately on death, that works too. If died second within 20 years in a joint life of male aged 45 and female aged 50. You can skip writing male and female because that was not mentioned. So you could just write joint life of person aged 45 and person aged 50. Two lives X and Y are independent with respect to mortality life X is subjected to the constant force of mortality of 0.025 and life Y is subjected to a constant force of mortality of 0.02. Calculate the probability that life Y dies more than 3 years after life X. When performing your calculation, you should set out an appropriate integral function and show all your working. So I've solved this in two different ways. The first one is I'm adding up all probabilities of time when Y dies and X would have died at least 3 years ago. So the time should start from 3 to infinity, and then you can substitute your TPX and TPY, integrate the value, and you will get 0.52302. The second way is you can say add up all the values when X dies and Y should live at least for 3 more years. So this will go from 0 to infinity, and again substitute all the values to get your same answer. Let's see the next question. Question number 5. A decreasing 2-year term assurance pays a benefit at the end of the year of death. The sum assured is 90,000 in the first year and 50,000 in the second year. No benefit is payable on survival to the end of the second year. Determine the mean and the variance of the present value of the benefit for this contract issued to life age 62 exact. Mortality is AM92 ultimate and the interest rate is 6.5% per annum effective. So we cannot directly take the values from our tables, at least not the assurance and annuity values. We will have to take only the probability values from the AM92 ultimate table. So the expected present value will say 90,000 given at the end of the first year if the person dies within the first year, and 50,000 given at the end of the second year if the person survives the first year and died in the second year. So accordingly we get 1349.555. For variance, we'll calculate expected of present value square. So all you have to do is take your present value and square it in the above equation. So 90,000 square and V square, and again 50,000 square and V raised to 4. So that gives you expected present value square. Your variance would be expected present value square minus expected present value whole square. And you can write it like this, or you can write it in terms of whole square. For the second part, explain without performing any further calculations how the mean calculated in part 1 would change if A. The age at which the life had taken out the policy had been older than 62, and B. Select rather than ultimate mortality had been used. So if the starting age is more than 62, the mortality is higher, that is more number of deaths within these 2 years. The expected present value will increase with the increase in the starting age. And B, the select effect of AM92 decreases the mortality at the same age. Hence, the expected present value will decrease if we use the select mortality. Let's go to the next question. The following information about the term structure of the interest rate is given. So you can see Y3 is missing. A 1-year zero coupon bond will be issued at time 3 and has a theoretical price of 95 per 100. So you can say we can find the F3,1 from this. Calculate showing all working and assuming no arbitrage. X, that is the 3-year spot rate, and B is 2-year discrete forward rate starting at time 2. So first we'll use the bond to find 1-year forward rate from time 3. Using that 1-year forward rate from time 3, we'll find the 3-year spot rate. That turns out to be 3.615. So for 2-year forward rate from time 2, you can directly use the formula using the spot rates of Y4 and Y2. And the value that we'll get is 4.205%. A 5-year bond is issued paying annual coupons at 9% per annum and is redeemable at 110% of the par value. Show that the annual gross effective redemption yield is based on this bond is approximately 4.29%, and third is comment on the numerical value of the annual gross effective redemption yield in part 2. So first thing is we'll use the spot rates to figure out the price of this bond. So it turns out to be 128.74. Then at 4.29%, I have calculated the price of the bond again, and it is 128.90. So we'll say as the price is approximately same, the gross redemption yield is 4.29. Now if I go with 128.74, the exact rate of interest I was getting was 4.32%, but I guess it is close enough to say 4.92. If you were getting 4.32, you did not do anything wrong. For the comment, we'll say the gross redemption yield is approximately the weighted average of the spot rates, where the cash flows are the weights. As the cash flow at time 5, that is 119, is substantially more than the cash flow at other times, that is 5. Actually, it is 9, it should not be 5. So let me correct that. The gross redemption yield is close to the spot rate of the 5th year. Let's go to the next question. When pricing fixed interest bond, the capital gain test compares IP to 1 minus T1 D by R, where all of these values are given. Show that if IP is greater than 1 minus T1 D by R, then there is a capital gain at redemption. The two situations where a capital gain test needs to be performed are for an investor who pays capital gain tax, and second is where the redemption date of the bond is variable. Second part, explain for these two situations why the capital gain test is necessary. For the first part, we can start with assuming there is a capital gain. That means our redemption must be greater than price. Substitute the value of price. Take redemption on the other side. This 1 minus v raised to n, 1 minus v raised to n will cancel out. Rearrange and you will get IP is greater than 1 minus T1 D by R. That means to figure out whether there is capital gain, this is the equation that we will use. For the second part, we'll say the capital gain tax is a proportion of the capital gain, that is R minus P, and is charged only if R is greater than P, or you can say R minus P is greater than 0. The calculation of the price will take the effect of capital gain tax. Hence, to find price, we need to find whether there is a capital gain or not. Second, when the redemption date of the bond is variable, to ensure the investor receives a net annual yield of at least I, they should assume the worst case result. In capital gain, the effective payment in redemption is more than that of the combined effective payment in coupons. Hence, the worst case will be when redemption date is the last possible date. Whereas in capital loss, the effective payment in redemption is less than that of the combined effective payments in coupons. Hence, the worst case will be when the redemption date is the first possible date. Hence, the capital gain test is necessary. Let's go to the next question. Question number 8. A life insurance company issues 20-year term assurance policy to lives aged 45 exact. The sum assured of 300,000 is payable at the end of the year of death. Level premiums are payable annually in advance for the term of the policy ceasing on the death of the policyholder if earlier. The insurance company uses the following assumptions. So we have M92 select, interest rate is 4%. We have initial expense, renewal expense, claim expense. We have initial commission, renewal commission. Write down the gross future loss random variable at the outset of the policy in terms of KX. The current future lifetime of the current future lifetime of age X. So for gross future loss random variable, we'll say 300,000 plus the claim expense, payment given at the end of the year of death, plus we had 250 expense as our initial expense, and for renewal expense we would have another 50 due ADU K45 plus 1 minus 1. So what I have done is taken this 50 minus 1 here. So I got 200, and the rest, that is our ADU K45 plus 1, goes with the premium. Same thing I have done with the commission. So from 25% I have deducted the 1.5%. So I have 23.5% of the premium, and the rest has been subtracted from the premium. This would happen if the person dies within the first 20 years, but if the person survives those 20 years, then all of the expenses would be given and all of the premium would be collected for the complete 20 years. The company sets the premium such that the expected present value of the gross future loss random variable is equal to the 4% of the expected present value of the premium income. Calculate the gross premium showing all working. So here they are saying that expected value of that loss upon the expected present value of premium must be equal to 4%. So we'll calculate that expected value of loss. We'll calculate the expected present value of premium in terms of P, both of them. And we will equate it in this equation. We get the premium being 1336.746. Let's go to the next question. Question number 9. A unit link policy has the following profit vector. Calculate showing all working the reserves required to zeroize the expected negative future cash flows at the end of year 2 and 3, assuming the non-unit fund accumulates at 3% per annum effective and QX is 0.02 for all ages. So for zeroization, we'll always go from the lower and we'll find the first negative cash flow. We are going to zeroize that by keeping reserves at time 2. Reserves at time 2 would be 39 upon 1.03. That becomes 37.864. We will deduct that from the non-unit cash flow of time 2, but only for the people that survive that year. So we get the non-unit cash flow at time 2 will now become minus 62.107. But we'll have to keep reserves because this is again a negative cash flow. So reserves at time 1 would be 60.298. We will deduct that from the non-unit cash flow at time 1 for only the people that survive the first year. So at time 1, we'll have minus 81.092 as our cash flow. Second part, determine the net present value of the profits assuming a risk discount rate of 8% per annum before zeroization and after zeroization. And third part is comment on the result you obtained in part 2. So I've written the main formulas used here for profit signature and the net present value. And I solved this in Excel and copy pasted in Word. So before zeroization, our cash flow would be whatever was given. We'll find our T-1 APX and profit signature would be profit vector into T-1 APX. Then the discounting factor would be according to the risk discount rate of 8% and net present value will be profit signature into discounting factor and then add them all up. Same thing after zeroization, but the cash flow would be different because we have zeroized the negative cash flows at time 2 and time 3 and all of that effect goes towards time 1 cash flow. So the net present value that we get would be lower and here we have 6.9 as our net present value. For the third part, we'll say setting up reserves only changes when expected profit emerges, not the amount of the profits. So the expected profit after setting up reserves will be unchanged. Setting up reserves delays the emergence of profit. The present value of the profit will change. In this case, the present value will reduce as the interest earned on the reserves is lower than the risk discount rate used. So the present value of profits with no reserves is more than that after reserves. Let's go to the next question. So question number 10 reads, On 1st January 2006, a life insurance company issued a portfolio of identical 25-year endowment assurance with the sum assured of 200,000 to life then aged 40 exact. The premium of 3885 are payable annually in advance and cease at the end of the policy term or on earlier death. The sum assured is payable at maturity or at the end of the year of death if earlier. At the start of 2021, there were 520 policies in force. Calculate, showing all working, the gross premium reserve per policy on 1st January 2021 using the prospective method. So the policy started on 1st January 2026, so that is 0, and we are calculating reserve at 1st January 2021. So if I subtract, I get 15 years. So we are talking about 15V. So for reserving basis, we have interest rate as 4%, AM92 ultimate. We are to ignore surrender. We have renewal expense, claim expense. We have renewal commission. So the reserves will be very straightforward. We have a benefit plus the claim expense given at the end of the year of death or on maturity. Then out of the premium, we will subtract the renewal commission as well as the renewal expense payable for the rest of the 10 years. So that gives us this much reserves. Next, they are saying the actual experience of the insurance company in respect of this portfolio of policies during 2021 was: first, the actual investment returns on the asset backing the reserve was 4.3%. There were 2 deaths. We had 10 surrenders, each receiving a surrender payout of 113,000 at the end of the year. Actual renewal expense attributed to the entire portfolio was 55,000. Total actual expense incurred on handling the death claim were 200. The actual renewal commission payment were 1% of the annual gross premium. The gross premium reserves per policy on 1st January 2022 is 113,238 calculated prospectively on the reserving basis. Second is calculate, showing all working, the total profit earned from this portfolio of the endowment assurance during 2021. And the third is comment on the source of profit, comparing the actual experience with the reserving basis. For the total profit, cash flow at the beginning of the year, out for 520 people were alive, and we will have this much premium and reserve that would be released at the beginning of the year, and the total expenses was given as 55,000. This will be accumulated to the end of the year by 4.3% rate of interest, and at the end of the year there were 2 deaths for which we gave sum assured plus 100 as the expense, and 10 surrenders giving this 113,000 value. And for the rest of 508 people, we will keep reserves. So the total profit turns out to be 159075.78. Then talking about the source of this profit, as the interest rate is higher than the reserving basis, there is profit due to interest. And second part is, as the renewal expense is more than the expense in the reserving basis, hence there is loss due to expense. As the actual number of deaths were less than the expected number of deaths, there is a profit due to mortality. And as surrender was not considered in reserving basis and surrender value is less than the reserve kept at the end of the year, there is profit due to surrender. So these were all the sources of profit. Let's go to the last question. So a loan of 300,000 was taken out on 1st January 2015. The loan is repaid by annuity payable quarterly in arrears for 12 years. The amount of quarterly installment increases by 400 after every 4 years. The installment were calculated based on the nominal rate of interest of 6% per annum, convertible quarterly. Assuming the equivalence principle applies, state the equation of the value which can be used to calculate the initial quarterly installment R. We just have to state the equation in the first part. So here I have done effective calculations quarterly. That means I have calculated my I star, that is the effective rate of interest per quarter, and written all my equations according to that effective rate of interest per quarter. You can do annual calculations here as well, but I find this is much easier. So our loan amount must be equal to our first 4 years of payment, then we'll have R plus 400 payment after 4 years and going for another 4 years, plus R plus 800 payment after 8 years going for another 4 years. You could have written this equation in another way. You could have said that R is going for the complete time, that is 12 years, and then 400 starts after 4 years going for only 8 years, so 32 payments, and another 400 starts after 32, that is 8 years, and goes for another 4 years. This would also give you the same answer. So the answer is 8475.431. Second part, using your answer to part 1, calculate R showing all working. So that was actually what we just did, calculated our R. Third part is calculate showing all working the amount of capital repaid in the first quarterly installment made on 31st March 2015. So we are talking about our first installment. So the loan outstanding is going to be the complete loan, and the interest paid will just be the loan multiplied by the effective rate of interest, that is I4 by 4 or I star in this case. So we get 4,500. So the capital repaid must be the repayment minus the interest paid, and that is 3975.431. Fourth part, calculate using an appropriate annuity function the amount of loan outstanding immediately after the quarterly installment due on 30th September 2022 has been made. You must show all working. First of all, let's figure out how many years are left in this case, or how many payments are left. So we started on 1st January 2015. So to 1st January 2022, we will have 7 years. So 7 years means 28 payments, and then we are talking about 30th September, that is the third installment. So third installment, that is in total 31 installments. So we are talking about loan outstanding after 31 installments. So after 31 installments, there are 17 more installments left. So last 16 installments plus one more installment of R plus 400. That gives me a loan outstanding of this much, that is 137,880.78. On 1st October 2022, the borrower asked to change the loan contract such that the quarterly payments would be level for the remainder of the term. The lender agreed provided that the interest rate was increased to 7.5% per annum effective, and that the original term of the loan is unchanged. Calculate using the appropriate annuity function the new quarterly level installment. You must show all your working. So now the rate of interest has changed to 7.5% per annum. So I have calculated I star, that is I4 by 4, as this much. Using that, we'll calculate how much will be the new repayment for the remaining 17 installments. It turns out to be 9506.521. The overall paper was very straightforward and it was a little bit lengthy, but could have been completed easily in our 3 hours and 20 minutes provided to us. Now, looking at the paper A as well as paper B, I feel like the passing mark would be anywhere around 56 to 57, as the papers were fairly simple. If you find any mistake in my solution, do let me know in the comments. I'll soon make the CM1 paper B video as well. So like, share and subscribe, and I will see you in the next one.